What if you could put a bulletproof vest around your investment portfolio to protect you from the bullets that the market can sometimes shoot at you? Well, that's sort of what you get when you have a well-diversified portfolio. Hi, my name is Kurt, and I'm a certified financial planner. And on this channel, I talk about money and meaning. Most people think owning a lot of different mutual funds means they're diversified. But here's what analyzing countless portfolios has taught me. True diversification can come down to three key questions, and getting them wrong could be costing you thousands in unnecessary risk. So let me show you what I mean. Last month, I sat down with a couple, both leaders in their fields, making great money, maximizing their retirement accounts, and doing everything right. Well, between them, they had a few dozen different mutual funds and ETFs between all of their various accounts. And when we dug in a little bit deeper, we found the vast majority of their holdings overlap the same exact investment categories. So today, I'll walk you through the exact framework that we use to fix this, show you how you can pressure test your own portfolio in under 5 minutes, and at the end, I'll debunk 3 dangerous myths about diversification that I see even experienced investors fall for. So first, what even is diversification? Well, you've heard the phrase, don't put all your eggs in one basket. That's probably the easiest way to think about it. If all of your investment eggs were in one stock, for example, that would be really risky and probably be a whole lot riskier than you could handle, which would cause you to jump in and out of the market at inopportune times. It's not uncommon for a single stock to move more than 10% up or down in one day. And this level of volatility is likely not going to help you reach your long-term goals. But not only that, but a crucial part of building a financial plan is sticking to the plan. And with that level of risk, not many people are built to handle it. I think the best way to visualize diversification is to look at this chart right here. This chart shows how different asset classes have performed going back more than 10 years. The best performing asset classes for each year were at the top, and the worst performing asset classes are at the bottom. Without even trying to read everything, because I know there's a lot on this, the first thing I want you to notice is that there's a lot of color. What that means is it's uncommon for the same asset class to be the best performer year in and year out. But we can also notice some trends. Notice that the purple box of cash is often towards the bottom of the quilt. This is because cash usually doesn't return too much. It's a great tool for managing short-term needs, but investing in cash long-term is going to eat away for your long-term goals. You'll also probably notice the green box, which is US large caps. And if you look at the top left, which shows the average for the entire time period, large caps have been the best performing asset class going back over a decade. But they're not the winner every year. Sometimes it's small caps, sometimes it's REITs, sometimes it's been emerging markets. Now I want you to notice that line that goes through the middle of the chart. This shows us how a fully diversified portfolio would have been performing during the same time period. You'll notice it's never really at the top, but it's never really at the bottom either. This is a great visualization of the effects of a diversified portfolio. More consistent returns means a little less return sometimes, but at a lot less risk, which can give you the confidence to stick with your plan and hit your long-term goals. If you're an investor, and in contrast to a speculator, you want both return and risk to work in your favor. Now, to be clear, this chart only visualizes returns. It really doesn't have a lot to do with risk. And if you're going to take away one thing from this video, it's that you cannot separate risk and return. They are two sides of the same coin. But this is a video about diversification, not risk. But the truth is there are a lot of risk out there. Volatility risk, longevity risk, behavioral risk, market risk, credit risk, etc. But let's just address one, and let's talk about volatility risk. This just means how wide the swings in any one of these boxes are over time. So this chart shows the volatility from the past 10 years for each of the same asset classes we just looked at. What you really need to know is that some of these asset classes, like stocks, real estate, are pretty volatile, while others, like bonds and currencies, can be a lot less volatile. So if you think back to that first chart, this is why that line on the quilt chart tends to stay in the middle, because a well-diversified portfolio should have things that zig while others zag, leaving you with a portfolio that can absorb the bullets that the market can throw at you. which help you reach your long-term goals and also helps you sleep at night. So now that we have a better understanding of both risk and returns, how can I make sure that my portfolio is diversified? Well, there's a lot of ways to do this, but what you really want is a basket of things that aren't correlated, which means they don't all move in the same direction at the same time. So here's a few questions to ask yourself to see if your portfolio is diversified. Number one, do I have something besides stocks in my portfolio? This could be bonds, real estate, cash, or anything else that we saw in that pull chart. And there are more esoteric things that you can invest in that are not on that list. But if you only own stocks, you do not have a well-diversified portfolio, which makes your portfolio less resilient. Number two, do I own large company stocks and smaller company stocks? A lot of people love to talk about large company stocks because they tend to be household names, and they have performed very well over the last several years. But if you're not investing in mid-size or even small companies, your portfolio is not as well diversified as it could be. And number three, am I too diversified? Yes, there's such a thing as too diversified. If your portfolio has dozens of mutual funds, ETFs, individual stock positions, you're likely over-diversified, which means you're adding complexity and likely fees are probably higher than they need to be. Mutual funds and ETFs are a great place to start because they're baskets of a lot of different holdings. If you simply start by having more than one asset class and more than one company type in your portfolio, you're well on your way to a well-diversified portfolio. And that should give you confidence in your strategy that will help you weather market meltdowns. Remember, the best plan is the one that you can stick with. So now we've discussed what diversification is. I've given you a few simple questions to check to see if your portfolio is diversified. Now let's talk about 3 myths that I've seen a lot around diversification. Myth number 1 is that diversification eliminates risk. Diversification at its core is a tool. It's meant to balance the returns of your nest egg with the risk of investing in the market. And there's nothing you could ever do to completely eliminate risk. Myth number 2, this is one and done. Building a diversified portfolio is a great start, but this is not a set it and forget it situation. As the market ebbs and flows, the portion of your investments can shift. For example, if stocks takes off, that part of your portfolio might grow more than expected. So to keep your portfolio balanced, it's a good idea to check in and adjust things periodically. You might need to move some of your portfolio from one area to another. So this helps you buy low and sell high, manage risk, and stay on track with your long-term goals. If you want to learn more about asset allocation and asset location, click on this video here. And finally, myth number 3, working with multiple financial advisors is diversification. If you work with multiple financial advisors, you might think that you're more diversified, but it's very likely the opposite. You see, when you're mixing your eggs in the basket, the key to real diversification is uncorrelated assets, or things that zig and zag at different times. So unless your different advisors are working together to put together a basket of uncorrelated assets, you're simply duplicating what one advisor is doing, and that's not diversification, at least from a portfolio perspective. Now, the exception to this, of course, is if you have an advisor that specializes in something really unique, like private equity, venture capital, or some other type of alternative investment strategy. But for the vast majority of cases that I've seen, you just end up with higher fees, higher taxes, and only the illusion of diversification. So today we've talked about diversification, what it is, how you can make sure you have it in your own portfolio, and common myths that I've seen people have around diversification. I hope you were able to take something away that you can apply to your retirement plan today. And if you want to see more videos that explore money and meaning, hit that like and subscribe button. Thanks for watching.